Over the past 12 months, the stock market has rallied by a substantial amount. With this uptrend, we run into the question, how do we invest in the stock market at all-time highs? You might see and think that there are many dangerous scenarios that could happen. For one, stocks could keep going up and you could miss out. For another, a stock market crash could come and leave you holding plenty of falling stocks. In this video, I'm going to explain what Peter Lynch's thoughts about investing in stocks at all-time highs is, and what I'm personally going to do. With that being said, let's get right into it. Some of you may know Peter Lynch as one of the greatest investors of all time. In the 13 years that he managed the Magellan Fund, he achieved an average return of 29.2% per year. That return is more than twice what the S&P 500 did during that time, and is equivalent to a 28x return in just 13 years. In order to get a sense of what to do in the current market, we're going to take a look at what Peter Lynch stated in the year 1997, which was in the midst of the dot-com bubble. Internet stocks continued to go up, and many internet stocks were worth 10 times more than what they were actually worth. Lynch mentions in the following interview that trying to time the market is actually the worst thing you can do. Every year, we always have people trying to predict a stock market crash, and this is evident today with many investors. If a quote-unquote expert keeps predicting that a crash is coming every year, they're bound to be right at some point. Nevertheless, most of the time, those that try to predict stock market crashes are incorrect.
Remember this one, it's futile to predict the economy, interest rates, and stock market. I mean, people keep trying to do this. I mean, this would be useful. I would love to know when we get a recession. I'd love to know when interest rates can go up or down. I'd love to know when the stock market's going up. That would be helpful. I would like to get next year's Wall Street Journal. Unfortunately, you don't get it. I remember in 1982, we had a lot of people in this room around for 82. We had 20% prime rate, 15% long governments, double-digit unemployment, double-digit inflation. I don't remember anybody telling me about that in 1980. I remember anybody telling me about that in 1981. But in 83, I remember they said, well, the economy's bounced back. We're in a recession in 85. In 85, they said we have a recession in 86. In 87, something happened in October 87. I forget what something happened in October 87. Celtics lost 7 in a row. Something bad in 87. They said for sure we'll have a recession in 88. And they said 89, for sure we'll have a recession. And then 90, we're supposed to have the so-called soft landing, which we never had. So I've always said if you spend 13 minutes a year on economics, you've wasted 10 minutes. And
You might be confused here. If timing the market is impossible, then what are you supposed to do? The answer to that is, instead of trying to speculate, you need to deal with the facts of the stocks you own in the respective industries. What are the numbers that back up a business's growth potential, revenue growth, or financial strength? What did the business's management team say about the future of that business?
All you need to know about the stock market is it goes up and it goes down, and it goes down a lot. And that's all you need to know. Again, it'd be terrific to know what's going to happen in the economy, but I deal with facts. If inventories are going up, if copper prices are going down, if room occupancy is going the wrong way, if people are building too many hotels, I look at freight car loadings when I own railroad stocks. I deal with facts. I don't deal with people tell me something's going to happen in the future. You might as well call a psychic hotline for that stuff. I think you have a better average.
The important concept to understand is that time in the market beats timing the market. As long as you're spotting a company with great fundamentals, you'll end up coming out on top over the long term. In the following clip, Lynch shows how this worked with Walmart stock.
You could buy Walmart 10 years after Walmart went public. Let's say you're a very careful investor. You waited. You said, I don't know if this company can make it. You waited for Walmart to roll it out. You could buy Walmart 10 years after they went public and made 30 times your money. 30 times your money. 10 years after they went public, they're only in 15% of the United States. 1.5. They hadn't saturated the 1.5. You could say, well, why can't they go to 17? Why can't they go to 19? I mean, why don't I take a leap of faith here? Why can't they go to 26? All they did for the next 3 decades was roll it out. You could buy Walmart. If the day they went public, you bought it, you would have made 500 times your money. If you waited 10 years in Walmart, you made 30 times your money. You got plenty of time in this business.
The next topic that is extremely important is the idea of buying the next of something. Today, we see many people chasing the next Tesla, the next Amazon, or even the next Google. In a bull market, chasing the next huge opportunity may seem reasonable. However, you have to recognize that most of the time, that company will never become the next Tesla, Amazon, or Google. In addition to this, a common but dangerous habit is to worry too much over winning stocks that you didn't invest in. You don't have to invest in every winning stock. You just need a few or even one winning stock to make huge returns.
I literally, in one of my books, listed on 2 pages, in the 13 years I ran Magellan, I listed I think about 200 stocks, A through L, on the New York Stock Exchange. They went up tenfold or more that I didn't own while I ran Magellan. I had owned lots of stocks. I listed 200 stocks A through L. I stopped at the letter L, and I didn't own any of these shares. They went up tenfold or more, and I was able to do okay with Magellan. And people worry all the time about missing Microsoft, missing Western Digital, missing United Airlines. They spend all their time worrying about stocks they miss. You cannot lose money in a stock you don't own. That's a very important. The only way to lose money is buy a stock, have it go down, and sell it. That's the only way. And I swear that people, their spouse has to cut out the newspaper in the morning, cut out the C's, and the person will look at the M's. Oh my God, Microsoft's up 3. You know, I was going to buy 1,000 shares of Microsoft. I lost 3,000 of Microsoft last night while I was sleeping. You know, I missed that one. I'll catch the next one. That usually does not work. Toys R Us, there was a lot of copycats of Toys R Us. There was Child World, there was Lionel, there was copycats of Home Depot. Buying the next of something usually doesn't work. It's very bad. It's like buying on dips. I think it's always better to buy from dips. I always thought it was a better rule than buy on dips.
Another common but dangerous behavior that often occurs in bull markets is that stocks get thrown around with little to no analysis. When you or someone else doesn't have much analysis or don't know what they're talking about, they will eventually have horrible returns over the long term. In the dot-com bubble, we saw many purchase stocks that they didn't know much about. Sure, many internet stocks rose significantly over a few months span, but in just a year, many awful internet stocks ultimately went bankrupt. Today, there are many attempting to invest in individual stocks that are in sectors they're not knowledgeable about. For example, if there's one stock with medical terminology that you don't understand, but is advertised as one with huge potential, then you should stay away from that. Doing otherwise would prevent you from telling great companies apart from subpar ones.
Let's say the cement industry goes from crummy to semi-crummy to fairly good. Yeah. The stocks are going north. Right. You're going to make money. That's the industry you know. What if you know the publishing industry? Some people have an edge. You work. I mean, what if you last 30 years you worked in the restaurant industry? You would have seen Taco Bell. Right. You would have seen Sbarro's. Right. You would have seen Pizza Hut. You would have seen Chili's. You would have seen these companies doing very well. You should have bought those instead of trying to buy biotechnology stocks you know nothing about. I mean, people have this tendency to always buy something they don't. All you need is a few, Charlie, all you need is a few good stocks a decade.
But this is your song. This has been your song for a long time. Only buy what you know.
No, but people are waking up in the morning and say, there's 5,000 companies out there. Which one should I buy? The average person ought to be able to follow 4 or 5 companies. They ought to be able to lecture on them. They understand the companies. And this forces you. This tool says to you right down the story.
At this point, you're probably wondering what you should do. After all, we've already discussed many activities you shouldn't do. According to Lynch, you should find companies that will grow significantly in the future and always look at the long-term vision. It's impossible to predict what's going to happen to a stock in 1 or 2 years, but it is possible to predict a 5 to 10 year movement, and that is what you should be doing when stocks are at all-time highs. You should be analyzing whether earnings or cash flows are going to be significantly higher over a long period of time.
So I have no idea when the market's going to go down and no idea when it's going to go up. I'm totally shocked. The market was 4,000 2.5 years ago. A little while ago it was 8,000. I had no idea about this. Very surprising to me. But I'll guarantee you the market will be a lot higher in 15 years. It'll be a lot higher in 25 years. What it's going to do in the next 1 or 2 years, I don't have any idea. And if somebody in this room knows about it, they're not telling anybody. Or they're not in this room. They're down in Palm Springs somewhere. You know, they've made $1 billion. I know we've had 96 years a century, and the market's fallen 53 times. We've had 53 declines of 10% or more. So 53 declines in 96 years. Once every 2 years, we have a 10% decline. Of the 53 declines, 15 have been 25% or more. So 15 in 96 years, about once every 6 years, the market falls 25% or more. That's what we call a bear market, you know that. And it's going to happen. I don't care when it's going to happen. I would love to know. Obviously, it would be very useful to know when it's going to happen. It doesn't make a difference to me. Corporate profits will be a lot higher 8 years from now, a lot higher 16 years from now, a lot higher 30 years from now. That's what I deal with.
To go over what we should do according to Lynch, we need to see whether stocks will be higher in 5 to 10 years, and that applies to index funds too. If you can justify a significantly higher valuation for the stock market or certain individual stocks in 5 to 10 years, then you should be investing based on that knowledge. And that's what we do on this channel. By the way, my Patreon is now open. Over there, I show you my personal stock portfolio with explanations, in addition to exclusive stock reports, exclusive videos, valuation spreadsheets, and more. If you're interested in joining or if you're just curious, check out my Patreon in the description below. If you enjoyed this video, please hit the like button and don't forget to subscribe, and I'll see you in the next one.